Before we start this video, do like and subscribe to our channel and not miss on any updates.
Then moving on to the next standard, which is Ind AS 16 on property, plant and equipment. Now as far as property, plant and equipment are concerned, they are the items which are held for use in production or supply of products or for rental or administrative purposes. Rental of your land building component which is held at investment property, which is covered by, this will be covered by Ind AS 40 and it is expected to be used for more than one period. You can just remember the definition. Then bearer plant is also considered to be an item of property, plant and equipment. Bearer plant is a living plant that is used in the production or supply of agricultural produce, is expected to bear produce for more than a period of 12 months and has a remote likelihood of being sold as agricultural produce except for incidental scrap sales, right. So for example, mango tree, orange tree and all of those things, those are your bearer plant. Bearer plant are covered under Ind AS 16. Then how do we compute the carrying amount? You will take the gross book value, this is nothing but your cost, minus accumulated depreciation and accumulated impairment loss. This you will understand in Ind AS 36. Now, what is the recognition criteria for PPE? It should be probable that future economic benefits associated with the item will flow to the entity and the cost of item can be measured reliably. Similar conditions you will learn in Ind AS 38 and also Ind AS 40. If there are spare parts, standby equipment and servicing equipment, if they meet the definition of PPE, they will be measured as per Ind AS 16, otherwise they will be measured as per Ind AS 2. Now, how do we do the measurement at initial recognition? It can be, now there could be multiple scenarios. One is you directly pay by cash or it is taken on credit. If there is a self construction and there is an exchange of monetary asset. If it is by cash, whatever amount you have paid, at that value you can recognize. If you have transferred some asset, that will come under this criteria. If it is self construction, then you will add all the construction cost and calculate the value of PPE. Now the next question is, what is the cost of an item of PPE? You will take the outright purchase price, then non-refundable taxes and duties, initial delivery and handling charges if it is given, cost of site preparation if you have to prepare the site to install the machinery, installation and assembly cost, professional fees, this is for design and all of those things, borrowing cost if permitted by Ind AS 23, then cost of testing minus net sale proceeds. If there are any cost of testing to make the PPE ready for its use, that also you will capitalize, but if there are any incidental sale proceeds while cost of testing, that will be reduced. Now here one thing you have to keep in mind is, if net sale proceeds is greater than the cost of testing, the amount is deducted from the cost. So if the sale proceeds are greater, then you will treat it as a reduction from the cost. Then very important, present value of decommissioning and restoration cost in accordance with Ind AS 37, that is, if I have to carry out some decommissioning activity after let us say 15 years or 20 years at the end of the useful life, the present value of that should be considered. Now generally, whenever Ind AS 16 question is asked, this point is definitely covered in the question. Then any other cost to bring the asset to the location and condition necessary to operate for its purpose intended by the management. So to bring it to its condition and location as intended by the management, that should be considered. You will reduce any government grant which is received specific to the fixed asset as per Ind AS 20 and trade discounts and rebates if it is already included. So this is your cost of PPE to be classified. What are exclusions? Important from your MCQ point of view. Cost of conducting business in a new location or with a new class of customer, any cost incurred in introducing a new product or service, cost of opening a new facility, ribbon cutting and all, administrative and other general overhead expenses. Then if it is a self-constructed PPE, apart from the cost that we have discussed above, you will also take cost of construction that is directly related to the specific asset. Please note, you will take only the cost, you will not add profit element to it. Cost that can be attributable or allocated to the construction activity, borrowing cost if it is a qualifying asset. You will not take, as I told you, profits and the cost of abnormal amount of wasted material, labor or other resources. So even in inventory, abnormal amount of wasted material, labor and resources, they are excluded. If it is an exchange of non-monetary asset, then you have to see whether the transaction has commercial substance or not. So generally, if same type of assets are exchanged, they don't have commercial substance. But then if it has commercial substance, then you have to see whether you can measure the fair value of asset acquired or given up. If it does not have commercial substance, you will directly take the carrying amount. If you don't have the fair value, then also you will take the carrying amount. So if fair value is not available for either asset given up or asset acquired, take carrying amount. If it does not have commercial substance, take carrying amount. But if fair value is available, then the first preference is fair value of asset given up or fair value of asset received. If both are available, take the one which is more clearly evident. So basically, finally the conclusion is take the one which is more clearly evident. So if both are evident, then fair value of asset given up is the first preference, because that is the amount you are actually paying to acquire the asset. Then when should we stop capitalization? We should stop capitalization when the PPE is in the condition, location condition necessary for it capable of operating in the manner intended by the management. So when the management thinks that yes, it is in the condition and location for being operated, at that point of time you will stop the capitalization. Subsequent cost, if it is day-to-day repairs and maintenance, you will charge it off to P&L. If it is replacement of parts of PPE, then what you will do, you will de-recognize existing component and you will capitalize the new component. Major inspections and overall, they are capitalized. Then very important, if asset is acquired on deferred credit terms, then you will take the cash price or you will consider the present value of deferred payments. Sir, what about the difference? The difference is considered as interest expense and it is added, or it is considered as a part of your borrowing cost. And as per Ind AS 23, if it is a qualifying asset, then you will add it to the asset, otherwise you will just expense it off. Then comes depreciation, very simple. So depreciation is calculated based on the depreciable amount, that is your cost or revalued amount minus the estimated residual value. When should we start depreciation? When the asset is available for use, not when the asset has been not when the entity starts using the asset. When the asset is available for use, on that date you should start charging depreciation. And when you stop depreciation, either it is classified as held for sale or on the date on which it is de-recognized, means I have stopped using it, on that date I will stop charging depreciation. Then if the asset has components which have different useful life, for example in case of an aircraft, engine may have a different useful life, the seats may have a different useful life, then in that case what do we do? For seats we will charge depreciation separately, for aircraft we will charge depreciation separately, that is called component accounting. Then there are different methods of depreciation, straight line, diminishing balance, unit of production method, this you would be aware of anyways. Now coming to depreciation on an addition or extension to an existing PPE, means I already have an asset, I have added something else. Then if it cannot be used independently, you will depreciate over the remaining useful life of existing asset. Means let's say I have a two-wheeler, I have added one more seat to it, okay, making it a 3-seater. Then if it cannot be used independently, depreciate over the remaining useful life. So in my case I cannot use it independently, so I will depreciate it over the remaining useful life. If it is independent and has separate identity, depreciate independently on the basis of its own useful life. Measurement after recognition, cost model is straightforward. Main important is revaluation model. Now what is revaluation model? Revaluation model basically means that I am carrying the property, plant and equipment at its fair value and not using the cost model. So in this case there are two ways to do the revaluation. One is depreciation elimination approach. Basically you will take the cost, depreciation, carrying amount. Let us say cost is 1000, depreciation is 200, carrying amount is 800. Now we have revalued to 1200. Then what you will do? You will eliminate this depreciation and from 800 you will move it to 1200. The other one is restatement approach. In that case what do I do? 800 I will make it 1200, that is an increase of 50%. So this I will make it 1500 and this I will make it 300. So this is called the restatement approach. Now the most important thing is how do we treat revaluation? If it is first time revaluation and if it is an upward revaluation and there is a gain, we will credit it to other comprehensive income as a revaluation surplus. Then if it is downward revaluation, if it is a loss, then charge to P&L. This is for the first time. So upward revaluation, increase the value of PPE, credit to revaluation surplus, downward P&L to PPE. Subsequent revaluation, that is where things become tricky. if first time is upward revaluation, first time upward, then if subsequently also it is upward, add to revaluation surplus. If subsequently it is downward, then whatever is available in revaluation surplus for this asset, use it, use the existing surplus and balance charge to P&L. Please remember, this surplus has to be of that specific asset only. You cannot use other assets revaluation surplus for this purpose. If first time it is a downward revaluation, initially it was downward, subsequently it is upward, then what do? Whatever we had charged to P&L, to that extent we can credit to P&L and balance to revaluation surplus. Subsequently, if it is downward, then the amount will be debited to P&L. Then what do we do with the revaluation surplus? Periodically, considering the difference between original depreciation and revised depreciation, you can transfer that amount to retained earnings, or when the asset is derecognized, at that point of time you can transfer to the retained earnings. When do we derecognize? When the asset is disposed, means we have sold, discarded, scrap, or when no future economic benefits are expected from its use or disposal. We will not get any future economic benefits, then in that case we will derecognize the asset. Then there is a specific guidance in Appendix A related to changes in existing decommissioning, restoration and similar liabilities. So here what you have to keep in mind is, if whatever is the change in liability shall be added to or deducted from the cost of the asset in the current period, and decrease in liability cannot exceed the carrying amount of the asset. For example, liability is 100 and carrying amount of the asset is 50. Okay. Now this liability, if it has come down to 20, I cannot reduce this. I cannot reduce it more than 50. I cannot make it negative. So if the decrease in liability is greater than carrying amount, excess has to be recognized as income. Only this thing if you keep in mind, it is more than sufficient.